Hey, this is Reginald Perryman with ReggiesRealEstate.com. Here today, April 17th, to give you some real live real estate data on what's happening here in the Michigan area. The biggest question I get is, will this market and this crisis be similar to what we had in the early 2000s? And I'm going to show you guys some data and some information that's going to support my opinion as to why I don't think the market is going to crash like it did before. There will be some changes, so we're going to show how unemployment is going to impact our market, or maybe not. So I'm going to break it down to you today in this video. So here we go. So let's just I'm just going to do a quick search through our Tri-County area, which is Wayne, Oakland, and Macomb. So here in the past 30 days, today is April 17th. So this is going back to March 17th, 2020. So there were a total of 578 homes listed on the market in the past 30 days since March 17th. And you can see, as you can see when we scroll through, the price point started anywhere between just $2,000 or $3,000 up to just the highest listed property was just over $3 million. The next highest was just over $1 million, and one below that. Then it drops down to $900,000 or so. So what's unique about this list, the cheapest property for $2,500 was in Detroit. Now, on the flip side, the most expensive listing was also in Detroit, coming in at just over $3 million. Now, you can see that Wayne County covers several cities. And again, here you have a property in Detroit for $867,000 listed. So this is why I actually love doing business in the city, because you have such a huge price range of homes. But you can see there's homes here in Westland, Taylor, so on and so forth. So let's go back to some real details for you. So let's look here. Now, a pending sale is a home that accepted an offer but has not yet closed, meaning that the home was on the market, a buyer submitted an offer, and it was accepted. So let's see how many properties were actually accepted and went under contract in the past 30 days. So again, in Wayne County, we have 579 homes that went pending since March 17th. The reason I bring that up is because the media will have you believe that nobody's buying properties. So again, let's look here. The most expensive pending sale was just over $1 million, actually just under $2 million. It was at $1.8 million. So I'm showing you real data in real time. And again, the lowest was about $4,000. Now let's look here. Now we don't only want pending sales, we want to see what has actually closed. In all fairness, most properties that have closed probably had deals pending prior to the epidemic and the lockdown. So keep that in mind. But with that being said, people were still confident enough to still continue with the sale and actually close, meaning that A, they either spent the cash on the property, or B, they were confident enough to take on a 30-year, 15-year mortgage. So here's the details here. So in the past 30 days, 942 single-family homes closed in Wayne County, and the lowest was about $4,000, with the highest closed sale being $1,750,000. So those are real facts for Wayne County. Just so I'm not going to go through all the data for each county, but I will give you guys an overview. So let's look here at Oakland County. What sold in the past 30 days, meaning what sold and closed. There were 917 properties closed in Oakland County. And let's go back to pending sales. there were 467 pending sales in Oakland County in the past 30 days. And new listings since March 17th, there were 629 new listings, meaning that 629 sellers decided to put their homes on the market in Oakland County. And in the past 30 days, we had 467 buyers go out and buy homes in Oakland County. So with just the two counties alone, we are over 1,000 deals. Now, in all fairness, again, during this time of the year, normally the numbers are a little bit higher. I can do a comparison year by year, but this is simply to tell you that real estate is still moving. There's always a good market for somebody. Macomb County numbers real quick. So for pending sales from Macomb County in the past 30 days, you had 323. So that's about 10 homes per day when you add it up. Closed deals, we had 622 closed sales in Macomb County. And active properties that just listed, we had a total of 347 properties that came on the market. So this is all within 30 days. Basically what we're seeing is anywhere between 15 and maybe 20 homes are going under contract every day in each county. That's not a bad market. So one of the major concerns we have about the real estate market is unemployment and its effect on the economy and how it's going to impact the housing market. So let's break this down. So before we can talk about unemployment, I'm going to tie this all in together because we have to look at the total population here in Michigan. So according to the census, let's look here, U.S. Census, and we go to housing. So owner-occupied housing rate, right? And this was based on the last census stats. About 71% of homes are 10 plus 1. So before we can talk about the unemployment impact on the housing market, first we have to see what the housing market is. And I'm going to tie this all in together so that you can get a better understanding of its impact and how it's going to affect you as a homeowner, you as a buyer and investor. So first, let's look here. So this is based on the census from previous years, but the most recent is 2014 through 2018. And these are stats for Michigan, right? So basically about 71% of households are homeowners, right? That means about 29%. Let's just make this even for calculations. 70% are homeowners, 30% are renters. Now this may vary depending on which city, and we know in some cities the rates can be as high as 35 or 40% renters and vice versa. So some cities only have maybe a 10% tenant population, non-owner occupied properties. So let's tie this all in. All right, so here we are. First, let's start with one of the reasons this is not going to be like the crisis before that we had. All right, so here in 2010, 2008, let's talk about housing inventory, right? 2008, we started seeing a surge in bank foreclosures coming on the market, right? Two things happened. The housing supply increased, the demand decreased, but there were still tons of homes selling. That's why I always say it's always a good market for someone, right? So investors were buying up properties. Homeowners, keep this in mind, owner occupants were buying properties for cash. Now, when we fast forward this video, you're going to understand why that's important as well. So housing supply, as a realtor, you talk to any appraiser, one of the things that's going to impact the market is months of inventory of homes on the market. Basically what that means, let's say, for example, all the homes on the market right now, without putting any new homes on the market, any new listings coming to the market, how long will it take to sell everything that's listed? Meaning, how long will it take us to sell out all the inventory? And back then, you can see in 2008, 2010, it was taking about 12 months, between 10 and 12 months to sell all the inventory. Keep in mind, new inventory was coming on the market, but based on the housing inventory and demand, that's where we were at. Now, if you look at today, the housing inventory is less than 3 months on average. So another important thing to keep in mind is the appreciation of housing values that went up before and what caused the appreciation, the rate of appreciation, and several other factors. One of the main factors were the type of loans people were getting in the early 2000s, 2004, 2005, the credit guidelines, the no doc loans. We all heard the story, so I don't have to repeat that. But basically, if you were breathing, you can get a mortgage. Anytime you don't have a lot of skin in the game, people will often spend more money if it's not their own, right? So after that, you have foreclosures. You had so many properties hitting the market. Homeowners that were not foreclosing were losing equity and things of that nature. So property values decreased. Here, there's been some great appreciation in values, but if you can see, if you base this on a $200,000 home, you had a 1% increase. You went up a few thousand. You may have went down a few thousand. Nothing real big. No leaps like here. You went up 4% and things of that nature. Plus, the other thing to keep in mind, the type of loans that were given during this time frame, people were putting anywhere, typical FHA, 3.5% down. You needed decent credit, 620 credit score better on most cases. And people were putting 5 and 10% down. People were buying homes this year and they had equity next year. Where here, they had equity, but just as quick as it was increasing, it started going down pretty rapidly year after year. Now, unlike the stock market, real estate takes a longer time to decrease in value. There's not a lot of bad high-risk loans that were used during this time frame. And keep in mind, in this range here, in between, you had a lot of people paying cash for homes. So, which brings me back to unemployment. Okay, so unemployment. Remember, only 70% of the people are actual homeowners. 30% are non-homeowners or renters, right? So let's just group everybody in this category as renters. Everybody here is homeowners, right? So out of every 100 people, 70 people are homeowners, right? And they mentioned that the unemployment rate can go as high as 15%. So let's just keep this simple. 70 homeowners out of every 100 people. The other 30%, 30 people, we have another slide for that. So 70%, this all ties in, just stay with me. 70 homeowners, so 15% of people are going to possibly be unemployed. That means 59.5% of the homeowners will still be employed. Approximately 10.5% of those homeowners will be unemployed. Now here's the thing. Here in Michigan, when your lender starts the foreclosure process, it still has to go to court. That's a possibility of it taking at least 45 days, right? Because you have to be late, then they have to give you some time, a grace period, before they even file for foreclosure and start the process. Most lenders will wait maybe 2 to 3 months, especially now they're going to wait a little longer and work with people in advance because they don't want a crisis again as far as foreclosures are concerned. So, but here's the thing. All right, so you start there. Let's keep it simple. Let's say it's 2 months. Once the property goes to foreclosure, then there's a sheriff's sale. After sheriff's sale, a homeowner has 6 months to redeem their property. During this time, they can sell it, refinance, negotiate a short sale, or come up with the funds to pay it off in full or work something out with the lender. But most of the time, all the workout plans have been exhausted prior to sheriff's sale. So let's say you're in sheriff's sale, you got 6 months plus the 2 months, so you're at 8 months. Once the redemption period is over, the bank still has to do an eviction on a property. This can take another 30 days or so. The reason I bring this timeline up is because this unemployed homeowner technically will have anywhere from 8 to 12 months before they actually have to move out of this home. A lot can happen. People can recover in 8 to 12 months financially, even if they lost the property. So let's assume that some of these people, of the 10 people, will just sell their home, take $20,000, $50,000, whatever equity they have in the property, and start over and just rent a home. Some of these people will go through the foreclosure process because they don't have the funds to rent a property. They're just going to ride their 8 to 10 months out, and once they find employment, they will go and find a rental property to rent or move in with family. But let's assume that all 10 people go through foreclosure. Worst case scenario. So here's the other thing to keep in mind. Even though I use the worst case scenario, that's not likely to happen. Here's why. Based on the stats, and I got these slides from Keeping Current Matters and Bloomberg as well. So over 53% of people have a minimum of 50% equity in their home, right? Now, 37% of those people, remember we talked about the mortgage crash. A lot of people paid cash for their homes. They have not sold yet. They have not refinanced or anything. The reason being is a lot of people that were losing their homes, that were paying $1,800 a month, so on and so forth. During that foreclosure process, they were saving up a year, maybe 2 years of payments that they would have normally paid, plus their income. They were saving up money and going, around the block to another neighborhood and just paying cash for a property, or they would rent and then save up money and pay cash because values had decreased so much. It made sense for them to buy using cash because they either had to rent or buy cash because they couldn't get a mortgage right away. Then the other 26+% have at least 50% of equity and these are the people that have mortgages on their homes. So when you combine the two, you have over 50, and now this is at least 50%. You have people with 10% equity, 20% equity, still they're in a good position to sell and not going to foreclosure. So when we go back to the people here, it's likely that, let's say at least 7 of them will probably sell their home before they allow it to go to foreclosure. Go back to the renters. Remember, 70% of households were owner occupants, 30% were renters. So let's look at unemployment. So if you took 30 renters, so out of every 100 people, 30 households were tenants, that means you have 25. If unemployment goes up to 15%, that means you have 25, just over 25 that are still employed. You have 4.5 that are unemployed. So what are these 4.5 unemployed tenants likely to do? Either they're going to get roommates or they're going to move back home or move with a family member. Right? Here's the thing. So if you are an investor, a landlord, for every 30 renters, there's a chance you may lose 4. But here's the kicker. Remember those 10.5 unemployed homeowners that possibly went into foreclosure, who can no longer buy a home? Guess what? And they've been saving money for the past 8 to 12 months. Guess what they have to do? They have to rent properties. So you're going to lose 4.5 here, but 10 new tenants are going to come into the market. So this is what I call the drop down. You drop down from owner occupant to becoming a tenant because you had a setback in your finances, which caused you to start renting a home again. So as an investor, this is really not really bad. The biggest issues investors will have if the market values start decreasing and you're over leveraged and you need to sell your properties. Say you have less than a 20% equity, and you're probably going to have some issues if you need to sell. But most smart investors that have rental properties are in it for the long haul. So if you are an investor, this is not that big of an issue for you. So here's why. Let's say you paid, I don't know, $80,000 for a rental property, and the value dropped to $73,000. Unless you owe $80,000 and you're trying to sell that property, that may be an issue. But most good investors that are buying investment properties to buy and hold, they're not so much concerned as of the market value, unless they're trying to leverage it for, refinance it, pull money out and buy more properties. They're more concerned about the cash flow. What happens when this scenario happens here? You have 4 people that are exiting the rental market, but you have 10 people that are going to enter. That's, again, supply and demand. I lose 4 customers, but I gain 10. There's absolutely no reason why I should reduce my rental rates. Because when we look back, let's look all the way back here. When we look back at the housing market here, what was unique, if you were in the market, you realized that rental rates did not change much. I mean, property values drop. We've seen some places property values drop 50, 60%. Rental rates didn't drop at all in those areas. Because what was $850 was $850 because you had all of these people entering the rental market. And again, that was great for as So I wanted to show you this because the concern is there going to be a housing crash? How is unemployment going to affect the market? The unemployment rate is only going to have an impact on the market for those people that actually own homes. It's going to have an impact on the market for those people that were in the middle of a transaction and lost their employment, or they were getting ready to enter the housing market. So there's going to be less people entering the housing market. How many? Approximately 15%. If this projection of unemployment is correct. As of February, we were at 3.6%, and that has increased. I don't have the March and April data, but a lot of people have filed for unemployment. Here's the thing. There's going to be people returning back to work. So I wanted to do this just based on this worst case scenario, right? So again, this is Reginald Perryman with ReggiusRealEstate.com. Follow me on YouTube, Instagram, Facebook. Like this video, share, and subscribe. Thank you.